In this video, we're going to talk about BIOLARGO, BLGO. To be honest, I almost took it as BNGO. You see what I mean? It's an interesting company for sure. And it's even more interesting how I came across it. Because it has some pretty well organized campaigns on different social websites. And I believe that even if everything that they say is true or false, the company itself is still worth a look for the reasons that we're going to outline in just a bit. So, as we all know, the environment or environmental preoccupations have become not only buzzwords, but a true factor in people's decision to whether they should invest in a company or not. It's not just that, but regulations have become tighter and tighter over time, which requires more costs and budgets for cleaning operations or restoration operations. And also, companies need to do this to avoid larger and larger fines as well, at least in the American market. So, BLGO does specialize in environmental solutions. It's also banking on the possibility for additional regulations, more needs for companies to look for cleaner solutions. And they happen to offer something that seems to be more efficient and cheaper than their competitors. So before I go forward, I just want to say this. Sometimes people may wonder, yeah, but I mean, how myself or yourself, you have the resources and the know-how to evaluate whether these claims are legit. The same kind of thing, questions arose regarding companies that are highly technical, for example, Palantir. My answer to this is we don't, and frankly, we can't. And to a certain extent, we shouldn't really care, because whatever they claim are sometimes just that, claims. Right? This is what they claim they can do to the regulators, to the market stakeholders, and so on. It doesn't mean that it's scientifically proven. At least, I don't consider that every single stock that I buy needs to meet this kind of criteria. And going in with NASDAQ in general, growth stocks or tech stocks, we kind of need to be comfortable with this notion that nothing is set in stone. They're sometimes not even set on paper. Well, actually, yeah, they are set on paper, but I mean, they're set on paper, but not even on concrete. So this is why going in, we also need to be skeptical to a reasonable extent. And the reasonable extent for me is I won't be scotched to these companies, right? Us as investors, we're not married to those positions. That's the bottom line. So overall, the analysis can be boiled down to the products seem to be pretty good. They are currently going against the NASDAQ trend. They do something positive for the society, so there is net added value for the society at large. It does have a very cheap or very low market cap. And the online following is something that is more pronounced for BLGO. In terms of basic company fundamentals, when we look at its financial statements, the company's assets are increasing over time, and they're increasing in a pretty balanced manner. Their debts, both short and the long term, are decreasing over time. The revenue are increasing significantly on a year-to-year basis. Their expenses are decreasing, especially the debt interest, which is good for the shareholders who might be worried about the going concerns. So either way, the company is not currently profitable, but it might get there in time given the current trend. The market cap is very low, so this would suggest that it can be pushed around. Now, this is also a double-edged sword. Usually companies with a very small market cap can have its price, being pretty volatile or more volatile than the large caps. And this would mean that your profit would be shown very quickly, right? It can increase very quickly, and also it can dip very quickly as well. But as you try to exit this position, let's say you've made, 171% or 200% on a given position with a penny stock or a company that's like very low. Well, at the end of the day, your position may not be able to get out at the stated price. You see what I'm saying? Because the volume might be so low that maybe the next bid is much lower than wherever you thought you sold it at. So this is a potential problem with small market caps. Of course, I personally have traded penny stocks, and I haven't really encountered this problem yet because I never went in heavy with small caps or penny stocks. So it's usually a question of controlling how much you want to risk and how much you should be putting in each and every small company. It's just a simple question of risk control, really. Now, this is regarding the company. I also want to talk about the promotions surrounding BioLargo. Basically, they seem to be very organized. They seem to write those articles because they're not really posts. They're articles. They're articles that are almost organized in like a similar method to those clickbaity ads, like those advertisements that are like, I know what you need. Your life really sucks, right? Well, here's a solution for you. Like that kind of ads. They followed up this kind of format. So in this market, things are pretty bad, right? Well, let me show you a great company that's, booming, growing, and I'm showing you this because it's not going to be at that price in just a little while. And your neighbor has already called. Okay, so it's this kind of tonality. And I've also seen a lot of like replies below with very positive remarks for BioLargo. They do seem a little bit made up. They do seem a little bit concerted or in concert. Now, let's assume the following. These are all trolls. These are all bots. These are all people who were paid 50 cents a post to post these kinds of things. Okay. So even if that's the case, it nevertheless put this company on our radar, right? I mean, BioLargo is a true company. Their financial statements are sent to the SEC, so they would be liable for like fraud and so on if they don't post the real financial data. As public companies, their numbers are audited by an audit firm. For smaller companies, it would actually surprise me if the auditors are willing to just turn a blind eye on things that are wildly exaggerated. Like, I don't think that this is going to happen because they don't want to risk their reputation for a small company. And by the way, I think that nowadays less and less auditors want to risk their necks for companies, period. Okay, because ever since Enron, Arthur Andersen went under, this has taught a very hard lesson for a lot of people working in the accounting industry. Anyway, that's just a tangent. I think that even if those, advertisements or promotions were a little bit made up, the company itself is worth to take a look at. The company has also existed for a long time, so that's also like something to remember. The company has been around for a long time. And from the looks of it, if we look at the previous 3 years, then the current stock price is relatively high. If we look at the previous 10 years, the current price is almost near its support level. Now, is this company going to exist 10 years from now? I think that the chances are relatively decent. Why? Because they're growing. And also because if they were able to tough out the past 10 years, why wouldn't they be able to do so as environmental regulations become, tighter and tighter? So in the short term, I would say that the momentum for the stock has been behind us. Okay, let's be honest. If you're here for a quick scalp, this is not the stock. However, all these seemingly fake promotion has successfully presented a company that I think is something that's worth our while, at least to examine closely. And it does seem to have real potentials. Okay. Its downside, I think, should be estimated around 25 to 50%, just like most small caps. And the upside, because it seems to be a decent company, it really could go to places, okay? Because the price is relatively cheap, so things that are above 100%, 200%, and so on, I really wouldn't be surprised. Finally, just as a full disclosure, am I going to buy BioLargo? Probably not, because my portfolio isn't sufficiently diversified in this area. I have quite a few small caps, small cap and risky investments in the holdings, and frankly, I think that my risk tolerance has been met. So if you want to buy BioLargo because you have a very diversified portfolio, because you're willing to take this kind of risk, because you believe that environmental issues will become more important as we go forward, then I think that BioLargo is worth your investment. The exposure should be controlled around 0.5 to 1% of your portfolio. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.